Silver just got absolutely wrecked. It went from $29 to a brand new all-time high of $121 in January, and then cratered 40% back down to $73 in a matter of weeks. Social media is in full panic mode. The rally is over. Silver is dead. I got wrecked. And then I thought, what would Warren Buffett say? Because Buffett has been here before. He once owned more silver than any single entity on Earth, watched it get cut nearly in half, and stayed calm. And when he finally sold, he said he sold too soon. Today we're going to look at silver's crash through the Buffett lens, what he'd see, what the math says, and whether the $500 thesis is arithmetic or absolute lunacy. Let's get into it. Let's start with history, because most people don't know Warren Buffett was once the largest private holder of silver on the planet. He bought silver twice in his career. The first time was in the 1960s, when he bought silver as a way to play its demonetization by the federal government. Then he did it again in a much bigger way. He bought 129.7 million ounces of silver, more than 25% of global annual production. His reasoning wasn't complex. When asked at a shareholder meeting how he could justify owning an asset that pays no yield, his reply had nothing to do with technical analysis, inflation, or any complex formulas. It came down to arithmetic. He estimated that the world was consuming perhaps 150 million more ounces of silver per year than it produced, a trend that had persisted for a few years. Supply deficit. Inelastic supply response. Growing real-world demand. That was the whole thesis. And the punchline? Buffett eventually told shareholders, "I sold too soon," after unloading the position. He sold around $10, $11 per ounce. Silver hit $50 in 2011. He left an enormous fortune on the table. Fast forward to 2023. At another Berkshire shareholder meeting, Buffett estimated that the world was consuming perhaps 150 million more ounces of silver a year than it produced. In 2023, he revealed how a silver bull market was by far the most likely of the possible outcomes. His prediction came true in 2025. So what happened? Why did silver go from $121 to $73? Silver prices experienced a sharp intraday decline on April 2, 2026, with spot silver falling approximately 5.5%, extending a broader correction from the commodity's parabolic January peak close to $120 per ounce. Three forces hit silver simultaneously. When silver surged above $100 in late January, the CME Group raised margin requirements sharply, forcing leveraged traders to sell. The US dollar strengthened significantly as the Federal Reserve signaled it would not cut rates soon. And profit-taking after silver's extraordinary 147% rally in 2025 created a natural correction. The Fed held rates at 3.5 to 3.75% and revised its dot plot down to just one cut in 2026. For silver, which had run from $40 to $121 in roughly 14 months almost entirely on dovish Fed expectations and dollar weakness, the signal hit like a sledgehammer. Here is the critical question you should be asking: did any of this change the fundamental story? Did the annual supply deficit disappear? Did solar panels stop using silver? Did AI data centers suddenly stop being built? The answer is no, no, and no. The Silver Institute reports that the global silver market is anticipated to remain in deficit for the sixth consecutive year in 2026, with a projected deficit of 67 million ounces. The market will continue to depend on metal released from above-ground inventories, highlighting that physical supply remains constrained. This is a leverage and macro correction, not a fundamental breakdown. Now let me put on the Buffett glasses for a moment. When Buffett was holding his 129.7 million ounces in 1998, the price dropped sharply below his accumulation range. He didn't panic. He understood something that most retail traders don't. The silver surplus lasted until 2021, when the deficit returned with a fury. The three largest silver market deficits in recorded history have been in the last 3 years. Structural deficits don't resolve in months. They take years. And when they finally do resolve, the price doesn't go up gradually. It lurches. His framework is simple. Is the fundamental imbalance still intact? If yes, short-term price noise is irrelevant. He's said it 1,000 times in different contexts. Be greedy when others are fearful. Right now, everyone is fearful about silver. The trap that Buffett himself fell into in 2006 is the trap to avoid today, he eventually told shareholders. I sold too soon, after unloading the position within about a decade. He saw the deficit resolving and sold, but the monetary demand surge came later. The deficit is not resolved in 2026. It's getting deeper. Okay. $500 silver. Let's do the math honestly. There are two roads to $500. Road 1 is the gold-silver ratio. Gold is currently trading around $4,600 to $4,700 per ounce. The gold-silver ratio sits at roughly 63. Historically, the long-run average is 40 to 60. In January 1980, during the Hunt Brothers silver squeeze, the ratio hit as low as 17. If gold reaches $10,000, a number increasingly discussed in institutional circles, and the ratio normalizes to just 20, its historical low, silver is $500. If the ratio goes to 40, still within historical norms, silver is $250. Road 2 is the industrial repricing thesis. Silver has quietly become a critical input for solar, AI-driven data centers, EVs, and the power infrastructure that keeps all of that running. Forces supercharging the demand for silver, from the rise of solar panels and electric vehicles to the age of artificial intelligence and the tens of millions of ounces that will be needed for semiconductors, aren't letting up. What do experts say right now, after the crash? Gold-silver analyst Alan Hibbert expects silver to perform better in 2026 than it did in 2025, and would not be surprised to see the price increase by over $100 per ounce to $175 or higher. First Majestic CEO Keith Neumeyer figures silver is going to reach $200 to $400 an ounce, at least, before this is all over. $500 is the extreme end. It requires gold at $10,000 and the ratio compressing to 1980 levels. But $200 requires only gold at $10,000 and a ratio of 50. That's not extreme. That's mean reversion. Let me be clear, Berkshire Hathaway has not confirmed any new silver position. But the setup is striking. The circumstances around today's silver rally are strikingly similar to Buffett's biggest silver purchase in his long investment career. Buffett's 1997 silver investment was a masterclass in exploiting structural imbalances. At the time, he identified a 100 million ounce annual deficit between production and consumption, a gap he believed would force prices upward. Today, the market is facing a similar, if not more severe, deficit. What would Buffett do at $73? Here's what his philosophy tells us. He would ask 3 questions. 1. Is the supply deficit still intact? Yes. 6 consecutive years. 67 million ounces this year alone. 2. Is supply inelastic? Yes. Supply hasn't responded to silver's 144% run in 2025. Mine production rose less than 2% last year. 3. Is industrial demand growing from real-world use? Yes, solar, EVs, AI, semiconductors. All 3 boxes are checked. In Buffett's framework, a 40% crash in that context is not a reason to sell. It's a reason to get interested again. The risk he'd acknowledge openly, the Fed staying hawkish longer than expected, a global industrial slowdown, and silver's brutal volatility. A total drawdown of roughly 50% from the January all-time high is historically not unusual for silver in a volatile year. Position size and patience are the tools, not market timing. Here's where we land. Silver remains 128.73% higher year-to-date compared to April 2025, despite the recent turbulence. The crash is real. The pain is real. But the structural story hasn't changed. $500 silver is a decade-long thesis, not a 2026 trade. $200 is a 2026 to 2028 scenario built on a ratio reset and continued gold strength. Neither is guaranteed. And I have to say this clearly, nothing in this video is financial advice. Silver is one of the most volatile assets in the world. It can halve from the top in any given year. Do your own research. Consult a financial professional before acting. But remember what Buffett said: "I sold too soon." The man who once owned a quarter of the world's annual silver production, who built the thesis on arithmetic and patience, watched the price of silver rise to 10x his buy price, after he had already exited. The crash doesn't scare investors who understand the deficit. The question is whether you have the patience to be right. Drop your silver price target in the comments. $100? $200? $500? Tell me where you think this ends. Like and subscribe if you want to stay ahead of what the smart money is doing in precious metals, and I'll see you in the next one.